Good morning, my name's James Garish and today I'm joined by Steve Jacobs. Steve's the new chairman of Shaw and Partners.
Pleasure to be here.
Exactly right. Also the chair of BTG Pactual and also on the board of EFG. So great to have you here, Steve.
Really nice to be here. Used to live here, so I love coming back here.
Yeah, beautiful part of the world.
And nicest part of the world.
I guess one of the interesting things from my perspective, and EFG has just come on board as a shareholder and major shareholder in Shaw and Partners, which we're all really excited about.
Yep.
One of the interesting things is about thinking globally. So in Australia, we tend to be very insular in the way we approach markets. I think there's a lot of data supporting that here locally. And I think it's a real opportunity for us to look further afield and look internationally. And I guess I wanted to start getting your take on, markets globally. I think BTG manage around $55 billion, a large asset manager globally. What's the big picture take at this point in the cycle?
Sure. And just on your earlier point, I think it's really interesting. I lived in Australia in the late 90s, lived here in Sydney, and what I've noticed coming back here every year since then, in the last 5 or 10 years, your point about Australians thinking parochially, I think it's changed quite a bit in the last 5 years or even 10 years. And you talk to the institutional investors here, which I do a lot, the Aussie super funds, etc. But you talk to private clients, and you can see that over maybe that last 5 to 10 years, they're thinking more and more and more globally, and especially the portfolio allocation is moving a little bit more globally as well. I mean, when I was here in the 90s, it was 100% Aussie equities, and I think now it's probably, in some cases it's 50% international, some cases it's 30% international. So I think just generally people are starting to think anyway more globally, and it's more of a globally connected world. Coming back to your question, it's really interesting times because, and I think everyone's talking about late stage cycle, and we haven't had this much of a economic upturn for a long time. I mean, we're going into since the GFC, over 10 years. And I know here in Australia you haven't had a recession for donkey's years.
Yeah, can't remember.
30 years or so now, isn't it? But it looks like that might turn in the next few years. Although you've just had a recent pop with the election results, and I see that, again, just being here 2 or 3 days, the business confidence has really kind of sprung up.
It certainly has, yeah.
It's kind of bouncing. More globally, it's more circumspect, though. And I think what's interesting, though, is what the US Fed has done or is doing in the last few months, where they're signaling, we're listening to markets. People are pricing in rates cuts.
Were you surprised at the significant about take by the Fed?
Yeah,
it was. In
I think the market's surprised because, in a good way, it's almost like we're having our cake and eating it now, because the Fed looks accommodating in terms of we're listening to the market. We now look like we're moving from 6 months ago, people talking about raising rates. Now we look like, probably 60 bips of cuts being priced in to the end of the year, probably like 100 bips of cuts by the time you get to this time next year. And, markets are reacting positively to that. I think...
How long does that last? So, I mean, we've had sugar hits from, obviously, QE coming out of the GFC. We've had, obviously, rates going lower for quite a while. The concern is that they can't cut forever, and they're cutting rates because underlying economies are starting to struggle. What's the longevity of rates cutting?
You know what? Why they're cutting rates is an interesting thing, because some of the numbers coming out of the US are looking okay, and some of the numbers are a tiny little bit of warning signs. I mean, take a little bit of a step back. We trade securitized mortgages and other asset-backed securities in the US. We're quite a big trader through some of our funds. And it's one of the early indicators that you see. You saw it last time around when you see, default rates go up a little bit. You're not seeing any indicators like that at the moment, and we're keeping a careful eye on that. But I think what's triggering the Fed's kind of, I guess it's reversal, is more the global geopolitical tensions, the trade wars, etc., and being a little bit careful about the data. If you took the trade wars out of the picture, we wouldn't be talking about rates cuts, in my view. So I actually think Trump's being pretty clever here. I think Trump is, and you've seen it with Mexico, let's rattle the cage, let's throw a few things around, then we'll agree something, and he's made his point. I do think that no US president has been re-elected on a downward economy. It's back to the economy stupid.
So we're talking about the Federal Reserve and Trump and the balancing act that's happening there. Ultimately, you believe a trade deal is likely, given what Trump has been suggesting?
I do, and I think what drives me to get to that conclusion is the fact that to get re-elected, he needs the economy on and up, and I think that would happen with getting a trade solution. I think the flip side is if that doesn't happen, and I know there's a school of thought where tariffs aren't, the reason tariffs are the answer for Trump. He wants the tariffs in place. There's a school of thought around that. He wants a protectionist US. Actually, I think the economy is going to override everything, and that will drive it. But if the trade war continues, I do think the Chinese will look to address that anyway, and they will have their own do whatever it takes kind of mentality where you'll see credit easing, etc., which they've stayed away from at the moment. But I think, easing credit, driving the consumer, the Chinese consumer, etc., they've got a lot of weapons that they can use. And that, again, I think is positive for markets, especially for Australia. So I'm upbeat on Australia. I'm downbeat on Europe. I think Europe's a very interesting place, but I think it is going through, you'll probably see the next 10 years, maybe longer, where it's going to be like Japan. It's an aging society in many places. You've got high youth unemployment in Southern Europe still. A kind of a hangover from the GFC that's still there. So you've got the best and brightest moving out of Spain, Italy, etc., moving to other parts of Europe to find work. Never great then for those economies. You've got Germany trying to reskill as to adopt to the modern world, and Germany's really powered Europe for the last decade and a half. And I think that, put those factors together, and I think you have a pretty low growth, low inflation rate environment, so just not very interesting. That's why I'd be focused. I think the US is going to be interesting, cutting rates.
So that's from an asset allocation perspective?
Asset allocation, you normally get, if the US is cutting rates, that's good for emerging markets. So I'm positive on emerging markets, but you're not seeing that at the moment because of the trade war noise. I think you take the trade war noise away, you get something happen there.
So what region is going to benefit most from the resolution, or expected resolution in a trade war?
So I think with the US cutting, trade war taken away, you get the key emerging markets benefiting. I think you will see China anyway stimulate further down the track. So I'm positive on China, which makes me positive on Australia. I'm positive on markets like Brazil, which we know pretty well, not least also because there's a new administration that's come in there that's very business-friendly, kind of a Reaganomics, Thatcher-style approach of slimming down the state, big economy, 210 million people, positive on that. And then you've got countries like India, another big emerging market. Again, post-election, people view it as stable, therefore following on policies. I think those big emerging markets are attractive. I'd stay away from Eastern Europe, Hungary, Poland, Czech Republic, because of my earlier points about Europe. And I would stay away from the lower yielding Korea, Singapore, etc., because I don't think they're going to benefit enough from a rates cut in the US. So US I like, Brazil, China, India, and then markets like Australia that are linked to the Chinese.
Yeah, Australia does. You made mention of post the election, a business-friendly government in Australia. We've moved from similar to what the US Federal Reserve was, prior to suggestion the interest rates were going up. We're now got an easing bias.
Yeah.
I guess it feels a bit better in Australia post election. The market's obviously benefiting. We traded to near 11-year high this week, which is obviously a positive. Other markets globally are also doing something similar. So look, it looks a reasonable outlook in my mind from equities in Australia. I'm interested in your take in US bond markets specifically. From the data that I read, there's still a massive support coming from buybacks domestically, share buybacks from corporates over in the US. It's been a big driver of US equity markets. You made mention of the mortgage market and etc. before. We're not seeing any stress in bond markets at the moment.
No.
Is that what your take is?
That's my take as well. But again, I'm a big kind of supporter of the fact that look at the bond curve and it's flat. It was inverted. I do see that as an indicator of a turning point. It's always been an indicator before. People say that, okay, it's different this time. But it's an indicator. It can be 6 months out indicator, or it can be 18 months out indicator. So I just think it's another, and I think it's a very key indicator that we are in a late stage cycle. And that in the next 12, 18, 24 months, you are going to see that cycle turn, which is why, as we all know, investing is relative. That's why, I talk about the rest of the world. And yeah, you're going to see the buybacks, the impact of the buybacks die down. You're going to see there's, the FANGs are under regulatory pressure. I mean, all big four have now regulatory issues or investigations that they're going to go through. I think that's going to be a factor. And I don't think the administration in the US can do any more tax incentives. I think that's done. So you all add all that together, and I think we're going to be moving in that market more towards bonds than equities in the coming 12, 18 months.
Steve, it's been fascinating talking to you.
Pleasure
to
speak.
I
love being here.
I hope to see you in Australia again very soon.
Yeah, I'll be here.